Income tax. The one everyone knows, the one everyone feels. Income tax is a tax levied directly on the money you earn, your wages, salary, and other forms of income. It is the single largest source of revenue for the U.S. federal government. Here's how it works in the United States. The U.S. uses a progressive tax system, meaning the more you earn, the higher percentage you pay. This is done through tax brackets. In 2024, the federal income tax brackets look like this. Earn up to $11,600, you pay 10%. $11,600 to $47,150, you pay 12%. $47,150 to $100,525, you pay 22%. $100,525 to $191,950, you pay 24%. And so on, all the way up to 37% for income above $609,350. But here's what most people get wrong. You don't pay the top rate on all your income. Only the portion that falls within each bracket gets taxed at that rate. This is called a marginal tax rate. So if you earn $50,000, you're not paying 22% on all $50,000. You're paying 10% on the first $11,600, 12% on the next chunk, and 22% only on the amount above $47,150. On top of federal income tax, most states charge their own state income tax, ranging from 0% in states like Texas and Florida to over 13% in California. The U.S. income tax was permanently established by the 16th Amendment in 1913, the same year the Federal Reserve was created. Payroll tax. Look at your paycheck. Past your income tax deduction, there are two more lines most people completely ignore. Federal Insurance Contributions Act. Payroll taxes fund two of the most important social programs in the United States, Social Security and Medicare. Here's exactly how it breaks down. Social Security tax, 6.2% of your wages, and your employer pays another 6.2% on your behalf. That's 12.4% total going toward your retirement. Medicare tax, 1.45% from you, 1.45% from your employer. That's 2.9% total funding your healthcare in old age. If you're self-employed, you pay both sides, the full 12.4% Social Security and 2.9% Medicare, totaling 15.3%. Welcome to being your own boss. Payroll taxes are regressive, meaning lower-income workers pay a higher percentage of their total income than higher earners, because Social Security tax only applies to wages up to a certain cap, $168,600 in 2024. Earn above that, you stop paying Social Security tax on anything beyond it. Capital gains tax. You bought Apple stock at $100, it's now worth $180, you sell it. Congratulations, you just made $80. Now the government wants their cut. Capital gains tax is a tax on the profit you make from selling an asset, stocks, real estate, cryptocurrency, artwork, or any other investment. There are two types: short-term capital gains, assets held for less than 1 year. These are taxed at your ordinary income tax rate up to 37%. Long-term capital gains, assets held for more than 1 year. These get a much friendlier rate, 0%, 15%, or 20% depending on your income level. This is why wealthy investors often pay a lower effective tax rate than middle-class workers. A billionaire who lives off investment income pays 20% capital gains tax. A nurse earning $80,000 in wages might pay 22% income tax. This difference has been at the center of the tax policy debate for decades. One exception worth knowing: your primary residence. If you sell your home, you can exclude up to $250,000 in profit from capital gains tax, $500,000 if you're married. That's one of the biggest tax breaks available to ordinary Americans. Corporate tax. Individuals pay income tax. Corporations pay corporate tax, a tax on the profits a business generates. In the United States, the federal corporate tax rate is currently 21%, reduced from 35% by the Tax Cuts and Jobs Act of 2017. But here's where it gets complicated. Most large corporations pay far less than 21% legally, through a combination of deductions, tax credits, depreciation allowances, and offshore strategies. Some of the largest companies in the world have paid zero in federal income tax in certain years entirely legally within the existing tax code. This is why corporate taxation is one of the most debated areas of tax policy globally. The OECD's global minimum corporate tax of 15%, agreed upon by over 130 countries in 2021, was a landmark attempt to stop companies from shifting profits to low-tax countries like Ireland or the Cayman Islands. The question of who really pays corporate taxes is also debated by economists. Some argue corporations pass the cost to consumers through higher prices. Others say workers bear it through lower wages, and others say it falls on shareholders through lower returns. The reality is probably a combination of all three. Sales tax. You walk into a store. A pair of shoes costs $100. You get to the register, it's $108.75. That extra $8.75, sales tax. Sales tax is a consumption tax, a percentage added to the price of goods and services at the point of sale. It's collected by the retailer and passed on to the government. In the United States, there is no federal sales tax. It's entirely set at the state and local level, which is why rates vary so wildly. Oregon, Montana, New Hampshire, Delaware, and Alaska, 0% sales tax. Tennessee, up to 9.55% combined state and local rate. California, up to 10.25% in some counties. Some states exempt essentials like groceries and prescription drugs, others tax everything. Sales tax is considered regressive, meaning it takes a larger percentage of income from lower earners since they spend a higher share of their income on taxable goods. Value-added tax. If you've ever traveled to Europe and noticed the price on the tag is the price you actually pay, that's because of VAT. Value-added tax, or VAT, is used by over 160 countries worldwide. The United States is one of the only developed nations that doesn't have one. Here's how it's different from sales tax. Sales tax is only collected once at the final point of sale to the consumer. VAT is collected at every stage of the production process: raw materials, manufacturing, distribution, retail. Each step adds a little tax, but each business gets a credit for the VAT they already paid at the previous stage. The result: the end consumer still pays the full VAT, but the tax is collected gradually throughout the supply chain, making it harder to evade. In the UK, the standard VAT rate is 20%. In Germany, 19%. In Hungary, the highest in the EU, 27%. Proponents say VAT is more efficient and harder to dodge than income tax. Critics say it's regressive, hitting lower-income households harder. Property tax. You bought your house, you paid for it, you own it outright, and yet, every single year, you get a bill for it. Property tax is an annual tax levied on the value of real estate, land, and buildings. It is the primary source of funding for local governments, paying for public schools, fire departments, police, roads, and local infrastructure. In the U.S., property taxes are set at the local level, and rates vary enormously. New Jersey has the highest average property tax rate, about 2.2% of assessed value. Hawaii has the lowest, around 0.3%. So on a $500,000 home, in New Jersey you'd pay roughly $11,000 per year. In Hawaii, roughly $1,500 per year. How is your property's value determined? A local tax assessor estimates the market value of your property. That assessed value is then multiplied by the mill rate, the tax rate, to determine your annual bill. Property taxes are controversial because they're not tied to your income, they're tied to your home's value. A retired person on a fixed income can be priced out of a home they've owned for decades simply because their neighborhood became more valuable. Estate tax. You spent your whole life building wealth, then you die, and the government wants a piece of that too. Estate tax, often called the death tax by its critics, is a tax on the total value of a deceased person's estate before it's distributed to heirs. In the United States, the federal estate tax only kicks in on estates worth more than $13. $61 million in 2024. Above that threshold, the tax rate is 40%. In reality, less than 1% of Americans ever pay the federal estate tax. But here's the distinction: estate tax is paid by the estate itself before distribution. Inheritance tax, used in some states, is paid by the person who receives the inheritance. 6 U.S. states have inheritance taxes: Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. The debate around estate taxes is fierce. Supporters argue it prevents the concentration of dynastic wealth across generations. Critics argue people shouldn't be taxed on money that was already taxed when it was earned. Sin tax. Not all taxes are broad. Some are laser-targeted at specific goods. Excise taxes are taxes on specific products, usually built into the price so you never even see them as a line item. The most common examples are gasoline, federal excise tax of 18.4 cents per gallon; alcohol, taxed per gallon based on alcohol content; tobacco, heavily taxed at both federal and state levels; airline tickets, multiple excise taxes buried in your ticket price; firearms and ammunition. Then there are sin taxes, a specific type of excise tax deliberately designed to discourage behavior the government considers harmful: cigarettes, alcohol, gambling, sugary drinks, even marijuana in states where it's legal. The logic: if something causes harm to your health, to society, to the environment, make it more expensive and people will buy less of it. Sin taxes serve a dual purpose: they generate revenue and theoretically reduce the behavior being taxed. Critics argue sin taxes are regressive. Lower-income households spend a higher percentage of their income on cigarettes and alcohol, so they bear a disproportionate share of the burden. Tariffs. Every time a foreign product enters a country, a government can decide to tax it. That tax is called a tariff. Tariffs are taxes imposed on imported goods, paid by the importer, and usually passed on to consumers through higher prices. Governments use tariffs for two main reasons. 1. Revenue. Before income tax existed, tariffs were the primary way the U.S. government funded itself. In the 1800s, tariffs accounted for the vast majority of federal revenue. 2. Protection. By making foreign goods more expensive, tariffs give domestic producers a price advantage. This is why they're also called protective tariffs. The most famous example of tariffs gone wrong: the Smoot-Hawley Tariff Act of 1930, which raised tariffs on over 20,000 imported goods, triggered retaliatory tariffs from other countries, collapsed global trade, and is widely credited with deepening the Great Depression. Wealth tax. What if instead of taxing what you earn, the government taxed what you own? That's the idea behind a wealth tax. A wealth tax is an annual tax on an individual's total net worth, assets minus liabilities. Cash, stocks, real estate, businesses, art, yachts, everything. Senator Elizabeth Warren famously proposed a 2% annual wealth tax on net worth above $50 million and 3% above $1 billion. The logic: many of the ultra-wealthy earn very little in traditional income. Their wealth grows through appreciating assets that aren't taxed until sold. A wealth tax would capture that. Currently, the United States does not have a federal wealth tax. But several European countries have tried it. Norway, Spain, and Switzerland currently have wealth taxes. France, Sweden, and Germany all tried it and abolished it, citing capital flight, implementation difficulties, and wealthy individuals simply moving their money, or themselves, abroad. The wealth tax debate comes down to one fundamental question: should accumulated wealth itself be taxed, not just income? It's one of the most hotly debated questions in modern economics. Carbon tax. The newest major type of tax on the global stage isn't about income or spending. It's about the planet. A carbon tax puts a direct price on greenhouse gas emissions, specifically carbon dioxide. Companies and industries that emit carbon pay a fee per ton of CO2 they release. The economic logic is elegant. If polluting is free, companies have no incentive to stop. Make it expensive, and suddenly, clean energy becomes the cheaper option. Canada implemented a national carbon tax in 2019. The European Union has a carbon pricing system covering major industries. Over 70 countries have some form of carbon pricing today. Supporters argue it's the most efficient way to drive down emissions while generating revenue that can be returned to citizens as dividends, sometimes called a carbon dividend. Critics, especially in heavy industry, argue it raises energy costs across the board, hurts economic competitiveness, and disproportionately impacts lower-income households who spend more of their budget on energy. Whether you support it or not, as climate change becomes more urgent, the carbon tax debate is only going to get louder. So there you have it: income tax, payroll tax, capital gains, corporate tax, sales tax, VAT, property tax, estate tax, excise tax, tariffs, wealth tax, carbon tax. They're all different, they're all debated, and they all fund the world you live in. Here's the thing about taxes most people miss: taxes are a mirror of a society's values. A country that taxes income heavily but not wealth is making a statement. A country with high corporate taxes is making a statement. A country that taxes cigarettes but not carbon is making a statement. Every tax code in the world reflects political choices about who should pay, how much, for what, and why. You don't have to agree with every tax. But understanding them is the first step to engaging with one of the most important debates in any democracy. Because at the end of the day, it's your money, and knowing exactly where it goes and why is the most powerful thing you can do as a citizen.